Hey, greetings. This is Mike Adamo, the developing trader, and I'm making another playbook video. This is actually my second one this weekend, on the same day. Or not on the same trading day, but different day of the weekend. Have a little bit of extra time, and I think this one gets to the ruthlessness that I need to have about the number one thing that I'm working on right now as a trader, which is execution and sizing. And I know that sounds like combining two things, but part of execution to me is properly sizing my executions and aligning those to the opportunity that exists. So even though I feel like it could be two things, at the end of the day, it's one. And this is the biggest thing that I can fix or make better to on my journey to become a consistently profitable trader, trading big size. So, back to, I don't know what happened there. I don't work for S&B. I am an independent retail trader. I am part of the S&B tier system, been involved in their training. So I will talk about the techniques and strategies that I've learned from S&B, and I will use their slide deck, but I am not an employee. This is not financial advice. This is just a dude talking about trading. So, and if you have feedback, ideas, or want to roast me in the comments, go for it. I can use the advice. And if you're in the S&B world, feel free to reach out to me on Discord. Love to talk trading. So this trade we're going to talk about is a pre-market high break, day three. The catalyst is an NVIDIA deal with NBIS 3 days earlier. And, the big picture on this is the index has not been very strong. The Qs have been kind of weak. If you want like a really deep, I'm gonna fly through these big picture slides because I did this for the same day, so you can refer back to the video I just made on Meta. But essentially, the market's been weak. We have been trading in a range. We pushed up to the top of the range and we rolled. Now we're going towards the bottom. We're at war with Iran. We're having a military action, and so risk is kind of off. The ETF filters, this is a typo, but favored an NBIS short. The broader tape was risk off, showing that the defensive ETFs were doing well, the offensive not so much. Again, kind of tech software being weak. No strong evidence of leadership from risk on. We were in a regime off area, volatility contracting, breadth decreasing. The index is making lower number of stocks above its 50, 100, and 200. And not making as many new highs. Market internals were weak. And the VIX was high. These are not things that favor along. So I think this is an interesting kind of playbook, right? Because it's like, this is a day three breakout. So, overall, NBIS has been showing strong relative strength versus the broader market. Given the strong day one move and technical setup, this trade offered solid expected value. That said, expectations should remain measured in light of broader market sentiment and larger headwinds reflecting the overall big picture. So let's talk about the catalyst, right? Because we're basically swimming against the current here. And I think, I think this trade would have been a lot better if we had a single update in the market in a bearish sort of environment. But it's not as good a trade when we have a weekday in the market in a bearish kind of environment or a weak environment. So NBIS announced the video would put $2 billion, AI infrastructure, all sorts of hot stuff. This would have made it go crazy like a year ago, but it's not a year ago. The one thing in favor was this high short float of 22%. So I think NBIS was definitely in play. This is definitely a, solid technical setup, but it had its warts as well and its signs. And that's really what I'm interested in talking about, right? Is like, for me as a trader, like every playbook used to say, oh, this worked, so therefore I need to put bigger size or better execution. And I think the reality with this is like this is not an A trade. This isn't even a B trade, given the market context and the kind of issues with the setup. And I think not you have to align your risk and your time with the best opportunities, and I think that is the key to consistency and not just trying to push risk on everything, because that will not drive consistency. So if we look at the NBIS technical setup, I think on a weekly, this is pretty decent. It made an all-time high in October. It spent 16 weeks consolidating. On this news, it broke that 100. It did fail once trying to get out of the consolidation, like 100 by 85. It tried once, it failed. And then it failed, and now it's it's solidly above. So that's not bad. I do think it's notable that what's missing last week is volume. Look at the up move here, look at the down move, and then look at last week. Right? There's just not as much participation. On the daily chart, on day one, we have our breakout. We have standard deviation volume, but it's been higher. Day two holds within, and it's holding above, the 100 and even the 110. But the volume isn't there. So it does 35 million shares in day one, which is not it's better than it has been, but it's not phenomenal. And it only does 15, 12, 13 million. So it's basically 37% of day one volume. So we want to see at least 50%. So that's a check against. So now we have an overall market that's pretty weak. We have a day that's pretty weak. We have a sector, which is AI, which is not as strong as it was. And we have a setup that's already saying, hey, participation isn't phenomenal day two. It's not phenomenal day one, but it has high short float, so maybe it will do something, right? So this is starting to not sound like an A. This isn't even starting to sound like a B. It's kind of starting to sound like a C. And if I'm wrong, give me the feedback, right? So we have pre-market resistance at 111. We have a strong opening drive, and essentially we roll. I mean, we hold up somewhat against day one highs, but we don't make a strong day three that breaks out and continues, which I think makes sense given the market context, right? So did I do two of these? Oh, it's the 15. So here's the intraday, kind of the same thing. So day three setup, day one strong directional move, day two inside consolidation, at least 50%. For less than 40 is loss of interest. Huh. Interesting. We had 37. So, we'll just move past that. Factors declining probability. RVOL. So we had an RVOL about 125. It's not terrible. Failure to hold the break in price. So it did that pre-market. Declining RVOL, market chop or volatility collapse. So market chop. We definitely have had a choppy market. So I traded this as a B with 20% of my stop. But I think this was over-risking for a mediocre setup. In a market that didn't support it, it's a weak day two. It's a weak overall market. This is a C trade. So here's how I traded it. More like a B. So I tried this twice pre-market, which I usually don't trade pre-market. So that was already a mistake, right? I wait for the day to open. And I tried this twice because apparently I really liked it, even though it had, a market headwind and poor day two volume. And believe it or not, I got stopped out twice. with less than full B risk, like C plus risk. I did take it down a little bit because it was pre-market and I'm not a huge pre-market trader. And I said basically I would give it one try after the open, which honestly on a C trade, I should have just been done with it. With my like kind of B level loss, 2 C pluses probably equal a B. But I did give it one more shot, and part of it is I wanted to be participating. And I actually did see risk after it opened because I said this thing's failed twice. Like on the third time, like, is this really a B? And so I took it at the pre-market high break. I added at the break of the consolidation above. I sold 30% into the highs as it rolled, and then I added back as it kind of did. Not really a 9 EMA continuation, but like a small kind of hitchhiker rebid. And then I sold 70% when it had a fail follow through high, and then I was all out when it kind of stuffed because it didn't feel that strong, and the market was fading. And so I'll give myself a D for execution. Those pre-market trades were unnecessary, and I think like the ads were not there. This is C trade. C trade means no ads. It means take one entry, see if it works, have a defined stop, and let it do its thing. So how should I trade it? I should have traded it by letting it confirm. So it failed twice in pre-market. So now pre-market high break. This isn't really a pre-market high setup. It's an ugly pre-market high setup. We really want to see it selling into the pre-market, into the open, and then break that high. This had like a shelf. So it holds above the shelf. It rebids. Put the stop at the low. It's kind of like a 5-minute range break, and no more ads. Basically, see what happens. Give it the opportunity to prove me wrong that it's a better trade than I thought. So sell 30% when it closes below the 9. Sell 30% when it closes below the 21. And when it puts in structure and can't hold, it's time to get out. So, I think it should have been kind of more of a move-to-move scalp than a bigger idea kind of trade. I'm not going to read the tape on this one today. I want to just make this a quick one. It's in here, so if you want to read the tape, you can go for it. But I think there was a lot of selling in here. It was another sign. But it did, it had a squeeze. So, the squeeze probably baited me in a little more than it should have. At the end of the day, the market context kind of gives the edge to like that these people aren't going to get squeezed that hard. So kind of an interesting one. I've covered technology before. So, I think I did well identify. Oh, this is what I was going to talk about. The opportunity cost here. So what was not a C trade was Meta on this day. And there was action and movement in NBIS, and there was a technical break of day one high. But what it did do is it took my attention off the A trade in Meta, which was a short trade, which fits the market selling, fits the environment, fits the theme, weakness in the market, weakness in an individual stock, weak day, technical breakdown. Like that is a better trade. That's where my time should have been spent. And this is again around execution and consistency, consistently scoring the opportunities, consistently aligning them with the bigger picture in the market, and consistently sizing them right is what drives consistency. So I think this was not a move towards consistency because this was sized wrong. This was against the market. There were other better opportunities that were better aligned, which is where time would be better spent. And this could have been a hard pass or a C trade that you just put it on, let it work, do other stuff. So, I think this was a good lesson for me. This is why I'm making this video, is to remind myself of this, and also to, if you bared with it and watch this, that you maybe like think about how this impacts your trading. Because that's consistency. Consistency is sizing right and executing well. Both of which I failed to do on this. So that's my plan, is to build in a better alignment with the market, to size down or pass on things that go against the broader theme, and to put my focus on the things that do align and are worth the size. So, let's see what else. And I think, a C setup you don't add. Like, that's a good rule. So that's my trade review for this. I thought this was, kind of interesting. I'm going to keep it short because this is my second one, and I'm going to move on and do some other stuff today. So thanks for listening, and I hope you found some value in here. I know I did, just talking out about it live, and look forward to any feedback or networking or connections that come out of this, because we're all just trying to get better every day. This is a tough business, and you need to work consistently on making yourself 1% better every day.